In this video we are going to take a look at a short trade idea in the Australian dollar 15-minute timeframe. In this trade we are going to use a combination of all three methodologies of the fractal flow channel, but the main method behind this trade is the market maker strategy. The fractal flow and the Newtonian trading strategy are only auxiliary in this case, but you will see how all three of them work together like a symphony. The first thing we should perceive in this chart is the difference between the major and minor flows. From number 1 to number 2, we can clearly see that price is rising, but it is producing small highs and lows on the way up. Those little highs and lows in between the market vector from 1 to 2 are part of what we call the minor flow. However, when price produces the market vector from 2 to 3, we can see the formation of the major flow. This market vector from 2 to 3 represents the first correction after the long vector from 1 to 2. When retail traders see this first correction and the formation of high number 2, they will immediately think that high number 2 is a great place to buy this market. If you have had access to the fractal flow methods, you already understand why this is a terrible idea. Technically speaking, the major problem with buying highs and selling lows is the trade location aspect. When retail traders do this, they are doing the opposite of what they should be doing because highs are technically the point of exhaustion of buyers, and lows are the points of exhaustion of sellers. For example, if you buy a high, you are likely to buy in a price level where buyers are not as strong, and if you sell at lows, you are likely to sell in places where sellers are not as strong. In a rough sense, you should aim to buy near lows and sell near highs, which is the exact opposite of what retail traders do. The issue here is that market makers are well aware of the fact that retail traders love to buy highs and sell lows, and this is the main axis of the manipulations that occur in the markets. Going back to the specific example of this chart, around low number 3, retail traders are eager to buy high number 2 because they think that if price surpasses that level, it will go much higher. Market makers know that, so they induce this type of behavior even more by giving the impression that the market will indeed shoot upwards. That's exactly what happened in the market vector between 3 and 4. Observe how organized that vector looks. Higher highs and higher lows with each candle. All three candles also have solid bodies, giving the impression that the market is sure about its main direction. This is a classic signature from market makers. When retail traders look at this, they increase their level of certainty about their long positions in high number 2. This obviously create a lot of orders in that level. What market makers will do is to poke this level to trigger all of those orders for them to be able to assume the opposite position of the market. That's precisely what happens in candle number 4. Notice how it pokes the high number 2 level, but it does not close above it. Right after number 4, we have the creation of an inside candle showing that there is a momentary stop in the progress of price. Observe that both candle 4 and its adjacent candle have highs that touch the wash line derived from the peak of high number 2. If you really understand what's going on behind the curtains of price in this example, you could even use that second touch to the peak wash line to enter a short position, but that's too advanced, and there are easier ways to take advantage of this situation. There is a second wash line drawn in the chart, which is based on the frequency along the upper tails of high number 2. That gives us a different level where might touch and reverse in the future. As usual, we have to observe what price does when it reaches those levels so we can make better decisions. Here is where we can employ the other two methods of analyzing the market to help identify market edges. Thinking in the fractal flow terms, we have a simple reversal divergence happening between highs 2 and 4. In number 5 we have the appearance of a fractal candle pointing downwards. The interesting thing here is that the high of this small fractal candle is touching our wash line based on the frequency of the tails along high number 2. Moving forward to subtler details in this chart using the upcoming Newtonian trading strategy, observe that there are two down-sloping black lines in the chart. The upper line is a mirror of the downward line, which has its origins in the minor low that precedes low number 3, and in the frequency along the tails of low number 3 as well. That's very different than using price extremes to draw channel lines. The mirror line, which is also placed in the frequency of the upper tails of high number 4, will touch the high of our fractal candle number 5 almost exactly as you can see in the chart. These two lines will give the outer boundaries and angle of this market, and the lower line will be used as a dynamic target for the short position. If you are wondering why the downward line was drawn using such price extremes, you should see that low 3 represents a break in the market vector from 1 to 2. In other words, low number 3 is almost like the level where the market seems to snap and change its momentum to the downward side. The trade you see opened in the chart was triggered at the open of the candle marked by the green arrow right after the fractal candle number 5. The stop was placed above the supposed manipulation in number 4, and the target will follow the lower downward sloping line as time moves forward. Let's see what happens next. Observe how price seems to respect the sloping lines, and they indeed point out market edges. This is about as precise as you can get with technical analysis. Our trade started with a potential risk-reward ratio that was less than 1:3, but due to the nature of dynamic targets, it ended up being a 1:3 risk-reward ratio because dynamic targets reward your time of exposure in the market. If you wish to understand how to trade like this in great detail, check out the strategy store. The fractal flow and market maker methods are already available for purchase. The Newtonian Trading Strategy video course is currently being produced. If you enjoyed this video, please support the channel by clicking the like button, subscribing to the channel, and leaving your feedback below. Thank you for watching, and I hope to see you soon.